CPI and PPI data came in a little better than expected, but it's the PCE that the Fed usually looks at, and so we're going to take a look at it as well ahead of that number, which is going to be reported at the end of the month. We have a couple of earnings still coming, and we got some interesting data on federal spending. We're going to talk about those things and take your questions today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. I am here, as always, on Fridays with my good friend and colleague, Professor Mark Guthner of Rutgers. Mark, how are you?
To you.
Oh, is today Pi Day?
Today is Pi Day, yeah. 3.14.
1.5. How far out can you go?
3.14159, and that's it. That's as
I
far as
think
I've memorized.
I think they had some. I remember I was watching some sort of talk show where they were interviewing a math prodigy, and took it out to some absolute ludicrous number.
Yeah.
Interesting thing to commit to memory. So, yeah, this was a pretty interesting week. Obviously, we're still chopping around in here. I wonder what your thoughts are, because the chatter, yeah, everybody keeps coming back to two things, right? So government shutdown and tariffs, as if those are the things that are what we should be most concerned about moving the markets. And I'll admit that, of course, they are going to have some form of an impact, but it occurs to me that there are other things that we should be looking at, including valuation, and you were saying a couple things about that to me earlier before we started today.
Yeah, I think our biggest problem is valuation. I did a little tweet this morning, and I showed how the stocks were going up, and then since the COVID low, our trajectory is much steeper than historical. And so I think people have gotten just too far ahead of themselves, and the way money has been thrown into the Magnificent Seven is a bit shocking to me. But I think people are overlooking this huge spend that they're doing on AI, and I'm not one to believe that they're going to get much of a return on investment on that investment, for years to come. And when they do, I think everybody's going to be disappointed that they'll probably have a mid-single digit, 3, 4, 5% return on investment, instead of the usual 10 to 15 that the big tech companies normally get. So I think those two things are a headwind. And as we talked about, to me, Apple is a bit of an enigma because it's no longer a growth stock. It hasn't been a growth stock in quite a while. Yes, their mix of business is changing a little bit from hardware to services, and services gets a little higher multiple. But I think the world is way too far ahead, and the upgrade cycle is really stretching out now for phones. I mean, I have a 12, and I've gone into the store to go get an iPhone, and it's the 16 now, and it's to spend the money is not compelling. So what do I need? A few more megapixels on my pictures, a little more memory. I mean, I'm not at the limit of my memory by any stretch of the imagination on my phone right now, and whatever my phone does, 10 megapixels or something is all I need. It's probably more than I need, and so I think I don't see Apple. It seems to me Apple and other stocks like it are overpriced and need to come back down to reflect their growth rates.
Yeah, that's an interesting one. In particular, to me, is Apple, because people who have watched the live stream with us before will know that unless you see a stock that is just overwhelmingly cheap, I usually have two criteria before I begin to think about whether I think it's worth picking a stock versus just picking an index. on the long side, and that is that, preferably you'd like to see the top line growing faster than S&P revenues are, and you'd like to see earnings growth that exceeds that of the S&P. And in Apple's case, we just don't see that, right? So the top line's been relatively flat. EPS has grown in part because of the accretive impacts of stock buybacks. I have on my screen right now a chart of the forward multiple for Apple, which is, at least as far as Bloomberg is concerned right now, about 29 times the consensus or the average of at least the analysts that are compiled in this one. And so, equities are relatively pricey, and Apple is more pricey, at least compared to the S&P, right? So I think I actually have the NASDAQ up here as well. Yeah. That's trading at 33, almost 34 times forward. Wow.
Yeah, so the way the back of the matchbook numbers I put on this is I just flip the PE ratio up down so I get the earnings yield. So for Apple, that's a smidge over 3%. Their cost of equity capital is probably in the neighborhood of 10 to 11%, maybe 12, but let's just call it 10 for a round number. That means they need to grow by 7% to deliver to shareholders, their desired rate of return. I just don't see that in the cards. I can see it 2-3%. So I think the stock is priced to give people a return of 5 to 6% for the next few years. And I think as people, if that indeed comes through, then the stock is going to sell off at some point because, people will realize they're getting a suboptimal rate of return and they're going to have to go find, other areas that are not explored. People get really lazy, late in bull markets, and everybody threw their money at 7 stocks and really didn't do their digging and their homework to try to find, other decent sized stocks, whether they're mid caps or small caps, that, have better prognostic, better opportunities ahead of them, that have some growth opportunity ahead. My real fear, but as I want to go back to, is I just think there's a massive overspend in this AI space, and dropping a couple $100 billion as an industry. You think about that, they need to start making profits of 50, $10 billion a year on that. I don't see anybody even coming close to doing that. You're going to see those be negative returns for the next few years in the hopes of getting really big numbers down the road.
It is interesting. Obviously, I think the news was a little bit disappointing for some Apple shareholders when they basically pushed back the expectations of when AI would be incorporated into Siri. I have a more Pollyannish view on the AI front for some businesses maybe than you have. So, for example, looking at Meta, Meta is investing a huge amount of money. One of the biggest spenders in the space. I feel that that's a company that rather needs to do that because they don't have quite as many legs on their business stool, if you will, as some others do. They've got 74,000 employees, and one of the things that I think about is that you can use AI to increasingly to write code, right? So you could, people keep thinking about, when is this going to translate into revenues? When's it going to translate into revenues? And I do worry that what will happen is that to a certain extent, some of the features that AI will provide to consumers will end up being commoditized, and the expected return on that investment might end up being lower than some investors might expect. But if you're focusing your AI in part on reducing your expense. So let's say that you use it for 2 critical tasks. Let's say that or 3, general operating services and things like that. If you think about the simplest example, maybe AI chatbots, right? Mm-hmm. So if you reduce the amount of money that you need to spend on things like customer service. But of course, for coding, this would also be tremendously important. So for a tech company that employs 74,000 people, is it so far-fetched to imagine that you could cut that by 50% or 60% or 75%
Yeah.
If you were able to deploy AI really effectively in the future? We know that the payrolls of some of these tech companies are bloated. I think Twitter, now X, demonstrated this. And so I guess my optimistic view is that this could help on the expense side of the equation.
Yeah, well, a lot of companies I think will benefit from it. It just seems to me that there's so many people throwing so much money on it, that the price competition is going to be really high. So the big beneficiaries are going to be maybe non-tech firms who are going to employ that technology in some new ways that maybe we haven't necessarily thought about yet. How is it going to help manufacturing, for example, or other services like legal services, medical services? It's going to provide benefits there. There's no doubt. The question is the people providing those services, will they get the rate of return that they want when there's 10 or 15 companies all fighting for that dollar? That's my
You know, you
concern.
you made an interesting comment that you felt like investors had gotten rather lazy deploying money into we'll call it the Mag 7. I guess my question is, and what are you teaching on this front? Because investors, I don't know if it's laziness, but they've been taught, even people like Warren Buffett, who is an active stock picker, have said, if you don't know what you're doing, maybe you're just better off making passive investments. And of course, there's two pieces to this. One is that a lot of people aren't making a conscious decision about how much they invest, when they invest, and what they invest in, because money just comes out of their paycheck, goes into their 401k,
Yeah.
gets allocated. Some self-directed investors might just be buying SPY or something like that. What are you telling your students these days about, both the benefits and the drawbacks of passive investing strategies? Because if the largest cap-weighted stocks are going to get the largest investment automatically in a passive investing environment.
Yeah, well, school of thought here is, academia is the house of the efficient market hypothesis. And so we teach that it's very difficult to outperform the indexes on a risk-adjusted basis by picking stocks, because there are so many people, there's millions, hundreds of millions of people, both professional and amateur, trying to find cheap stocks and cheap investments to buy. So prices are not necessarily too far out of whack. Maybe that could have been the case in the 30s or 40s, 50s, when it was harder to get information. You had to call up companies and actually get them to send you a annual report by mail, or you had to visit your local post library to go get information on companies. Now everything is there at your fingertips. So the competition is very keen. What I typically do is I say you probably want to have 2/3 of your money in index funds. So have an index bond fund.
If you're wondering what I'm doing, I'm just trying to see whether my camera will come in focus. I'm being told it's not focusing properly.
Okay. You look okay to me on my end. I thought that was a big halt.
No,
It reminds
no.
me of when I was driving through DC in the Beltway, and a cop ran out in the middle of the road, 4-lane highway, put his hand up like that and told me to pull over for speeding. Um, and he was doing it to lots of people. The guy was a nice revenue generator for the city of DC. But any event, I tell folks, you should probably have 2/3 of your money in index kind of investments. Maybe a little bit of EEM for emerging market, some large cap, so SPY, some tech, a little triple Qs. I tend not to be, even though I spent tons of my life in the bond market, not to be a huge fan of anything longer than intermediate term bonds, and I tend to like high yield more than investment grade on average. But I hate high yield bonds right now because I don't think there's any value there whatsoever. Um,
Uh, you want to explain why you say that?
well, if you go look at the average yield for high yield bond funds going back 30 years, maybe you get Treasuries plus 400 basis points during periods of financial distress. That might be Treasuries plus 7 or 800. And I think we're down. You might check really quick for if you could see what the spread is on HYG, let's say, for example. I last I checked, it was like 250 basis points, 200 basis
Yeah.
points, something
So
like
if we
that.
compare, so if we look at HYG, it's yielding a just under 5.9%, 588 bips. And if we compare that to say LQD, which is the investment grade ETF, that's 442. And of course, we know that the 10-year Treasury is also over 4%. So, you're looking at 140 basis points at best, maybe, to be in what people would otherwise refer to as junk bonds
Yeah.
instead of risk-free.
Yeah, I used to
Risk
get that.
risk-free.
Yeah, when I traded bonds, I used to get 120 to 150 basis points in triple B rated stuff, which is the low end of investment grade. So when I see that in the junks category, that just makes me feel like that you're just a guy picking up pennies in front of a steamroller, and you're gonna get run over at some point in time. And so that's not a sector I tend to like. I tend to not like bonds so much anymore because the Fed's always trying to figure out how much money can we print without getting inflation too high. They've already capitulated and said, we're going to shoot for 2% inflation, which means we're going to get 3 to 3.5. And I know we're going to get 3 to 3.5 because that's where we averaged since 1971 when we came off the gold standard. The average inflation rate, compounded average inflation rate for that time period, it's about 3.5%. So the way I read the between the lines is if rates inflation gets down to 2%, they're going to feel like they got the green light to print more, and so of course the surprises will be inflation of 3 to 3.5 to 4. So we're never going to be in a 2% environment. It's just my view on that because yeah, I don't know why you think if you just we only steal 2%, that's not stealing very much.
Yeah, so that's maybe a good segue then to talk about different inflation measures that people tend to look at. I think a lot of people look at CPI partially because there are things that are tied to it, right? So people look at certain inflation measures and that can impact things like Social Security distributions and other inflation hinged things like that. But the Fed looks at PCE. Do you want to talk a little bit about what the differences are between the various measures and who should be thinking about each?
I'm not sure I am enough of a policy wonk to know the difference, but I think PCE is focusing just more on regular run-of-the-mill consumer expenditures, whereas you get a little bit more flavor in CPI for things like housing and things like that. So I was never really sure why the Fed loved PCE because it had always been CPI and PPI when I was in the bond business. And then one day they kind of pivoted to PCE. And I think they're looking more at what people spend on every day. Um, and that index does that. So I think that's why they do it. I would rather and so it's I don't know. I don't have a strong view about the differences. That's my understanding, but I could be wrong.
Yeah, I mean, one of the issues that has crept in using if you can it's always nice to be able to distill what's going on in the universe to a number.
Yeah.
We can track a number, we can look at it, we can give it some context. The issue that some inflation measures historically had and they were always trying to massage them, was that they can be volatile, especially inflation measures that incorporate prices of commodities, which themselves can be volatile. I've often felt that they have tried to use measures which understate inflation. So, for example, the basket of goods that was originally used to calculate inflation ended up getting massaged when they started thinking about alternatives, right? So that, depending on the elasticity of a good, but you might find that if beef got too expensive, people would buy chicken instead, that sort of thing. I know that Jerome Powell has, his preferred measures. One of the things that they look for is a metric that tends to have somewhat lower volatility. So they often exclude those types of items. And that makes sense from a policymaker's point of view. How can you make policy if you're looking at a number that jumps all around all the time?
Yeah.
You can't really do much with that. I personally think that they claim to be looking at the inflation numbers and they claim to look at other things, but I think that what they might be sometimes looking at are the fixed income markets.
Yeah.
And you actually wrote, I kind of remember you wrote a paper about that a while back.
Yeah, so if you go and look at the historic data, I don't know if you could do a quick pull-up on Bloomberg, but compare the 2-year Treasury rate with the Fed funds rate, and the two kind of are right on top of each other. If you're if you want maybe something with a little lead or lag, you see that with 1-year Treasuries, that when 1-year Treasuries are above the Fed funds rate tends to get increased. When it's the other way around, when 1-year Treasuries are below, the Fed fund rate comes down. So sometimes I think they throw a party for 2 days when they're supposedly be talking about all kinds of arcane economic issues, but in fact, they're looking at a couple of market factors and they follow the market. So I personally think that's what they're doing. Now, they can affect the market price, though, a little bit. If they want Treasury yields to come down, they just step into the market and they start buying Treasury bills hand over fist. That's going to drive those rates down. That gives them the cover to lower the Fed funds rate. And vice on the other way around, it tends to be, well, they'll do the same thing, but really what drives them is when the inflation number kind of gets to be politically impalatable. You raised an interesting point that it's nice to boil everything down to one number. That's why equity investors love the PE ratio. It's taking a long look at what a company might make over the next 10 or 15 years and boils it down to one number. So that makes it a number that's a bit of, has the potential to be abused. But I think this similar factor takes place in inflation, because I don't see inflation as a number, I see it as a vector. And what do I mean by that? It's not one number that says if prices are going up at 3%, that everything in the economy is going up at 3%. Every one of us has a different basket of goods and services we buy. And so the inflation rate we see is some weighted average of all those things that we buy. So if the things that I want to buy are beachfront property, I'm faced with a inflation rate of over 10%, maybe 15% a year. If I'm trying to buy real estate, if my basket includes real estate in somewhere in the center of the country, maybe my inflation rate is 3 or 4%. It's much different. Am I buying high-end goods? High-end goods tend to have a higher inflation rate than low-end goods. So I think every one of us sees a little bit different inflation rate. And so that's why I think of inflation as a vector, not just a single number. That probably is a little much for the average person to think about, but being a numbers ninny, I guess.
I have on the screen actually the chart of the Fed funds rate versus the 2-year. And you can see that they track each other very closely. And arguably the more interesting point, if you're looking at it, is that there's a noticeable lag. In other words, the 2-year, which is white,
Mm-hmm.
it goes higher, and then the Fed funds rate goes higher. It goes lower, it starts to come. So there's basically the Fed funds rate follows the 2-year,
Yeah.
not the other way around. Which is I think that might surprise some people when they think about it, because they feel like rates are, it's just a policy decision, and then we kind of live with the consequences, rather than a essentially a consequence
Yeah.
of what's actually happening. And it kind of reminds us that there is only so much that monetary policy can do. So let's talk about a couple other things here. You were just talking about the inflation thing. So we have a couple discretionary things still on the radar. So we've got Carnival Cruise Lines, which is going to be reporting next week, which I think is kind of interesting. Monday Morning Quarterback has a question for you, Mark, which is that since we're talking about fixed income, where would you allocate your fixed income portion of your portfolio? You already mentioned duration a little bit, that
I would think about treasuries and not going any further out than 5 years. So
mhm.
I think 5-year treasuries are probably giving us 4.5%, something like that, 4.25%. And that seems like a reasonable rate of return if you think the inflation rate is around 3%, or maybe a smidge less than 3%. It also, if you were an active trader and you thought you were we're gonna go into recession, maybe you want to buy TLT for a quick flip. Rates coming down as the economy turns down. I'm of the view it's interesting. The GDP now is showing negative GDP estimates going forward. I'm expecting negative GDP print in the quarters ahead, principally because of something that's a little arcane, and that is government spending gets covered or gets counted twice in GDP. It's a flaw in the way they calculate GDP. And think of it like this: the government spends a bunch of money, and part of that money is going to employees of the government. And how many do we have? Have we found out in discussing with there? We've got millions of employees, right?
About 2 million civilian federal employees. If you include the Department of Defense and all the military, it's about 3.
Right. And then those guys go and they take that money and they spend it on consumer items. So that number is getting counted twice. It's showing up in consumer spending, and it's showing up that portion of government spending in in um, in the government number, because GDP is C plus I plus G, consumers plus investment plus government plus net exports. So if you've got net exports, that's a boost to GDP. If you have net imports, that's a drag on GDP. And so since we are in the process of reducing headcount in the U.S., I think it has a little levered effect, and we're gonna see a negative GDP print. And maybe that gets people all gunned up for a quick trade in bonds. But I think about bonds as a way of protecting your wealth, and not as a place to grow your wealth. So if you've got some money, you want to hold on to your wealth, you invest in bonds. If you want to grow your wealth, you buy stocks, because that's where the growth is. That's where the higher rates of return are. But there's more risk, of course.
Well, to your point, if you are saving for a beach house, fixed income isn't going to get it done, because the value of your dollar is going to go less and less far. You're getting farther and farther from the beach itself.
Yeah. Yeah.
If you're using bonds to save for that investment. Yeah. So that is. Let me pull this up here. Let's see if we have any other particular questions. One of the things. Oh yeah, FinWest. Aloha. How are you? Finwest says, I trade TLT each month with covered calls. It's been pretty near to 5% over the past year. What are your thoughts about TLT? So TLT, for those that don't know, is the long-dated Treasuries.
Yeah.
So that's much more duration than you would tend to prefer.
Mm-hmm.
How do you feel about that as a strategy, selling covered calls on TLT?
I generally like covered call strategies. I'm going to ask you to look up the implied volatility on TLT. Is it single digits at the moment?
I am assuming it is. It usually is. It's
And that's my only
it's not. Oh, actually, no. It's actually. Well, look at that. It's actually 15.3.
Okay, so that
For a 3 month. That's not so bad.
yeah, so that's pretty good for that on its long-term basis. Because you want, you don't want to sell options if you're not getting much time premium for them. And at 15%, that's okay, given that the volatility is not all that high either. So you're not that likely to get run through that upper strike when you write a call. So that's okay. I do a lot of covered call writing and cash covered put writing all the time as a basic strategy. That's one of the ways I got long some XM satellite. So I wrote some at the money puts on the back of Warren Buffett buying the stock, and I said, well, I'll go buy a little bit of that, and I'll step into it by selling some cash covered puts. I ended up getting elected, and so I own the stock. Unfortunately, that stock's not performing all that well right now, but at a 7 PE, I'm fairly confident that it'll eventually work, and I'm actually thinking of buying more of that name right now. But I like covered calls.
What do you think about the consumer right now? We were seeing a lot of evidence in the form of basically delinquencies, revolving credit balances, things like this that suggested that consumers were under significant pressure. This was confirmed more recently after Walmart reported, and on the call, one of the things they had mentioned was that they are seeing shifts in consumer behavior, especially towards the back half of the month, which is, or at least that's kind of what my recollection of it was. I have to go back and see whether that's something sometimes what I read and what I heard, I'm trying to remember, did I actually hear somebody say that or did I read somebody say that? But the indication was that, people were buying smaller amounts of things. So I actually alluded to this on an earlier live stream. You used to buy 24 rolls of toilet paper, now you're buying 12. Those types of consumer trends are pretty alarming. And they're alarming and they're distressing. It's distressing to think that people are being forced to make those kinds of hard choices. That's obviously not a happy circumstance. And I saw somebody, who I think reasonably highly of. I won't bother to mention her name right now, but she was talking about the fact that cash balances in the aggregate are quite good. But the problem I have with this is that those cash balances are just a single number. It doesn't really describe what's going on underlying. So if very rich people have huge cash balances, the median person might actually see their balances dropping. And actually, that's what the data shows. Is that the median balance has been falling, even though the total balances have been rising. And there's two things alarming about this. I'll just mention them quickly, and then we'll talk about discretionary spending. The alarming thing about it is that it suggests that most consumers have less money. And the other alarming aspect is that if discretionary spenders are spending less, they're deciding to, because that's really where the volatility in spending will come. People will, they'll spend what they have to eat and get by. But, you know, a lot of the strength in consumer discretionary, to the extent that we've had much, comes from people who can afford to spend money, but they don't have to. They don't have to buy those
Yeah.
goods. What are your thoughts there?
Well, it's one of the things that I have a problem with any kind of economic central planning is that there is not this one monolithic consumer. It's a whole distribution of people across incomes. It's across geographies, and cost of living in different geographies can be substantially different. You know, people pay to live in your neck of the woods, San Francisco, New York, is crazy. I remember, you know, a friend of mine came to New York, and I put him up in a hotel, the Omni Hotel in New York, and they charged a brownie um, to the hotel room that I was picking up for them. And then she didn't know that it was a family, that the family called me and said, "Listen, I'm really sorry about that brownie. It was like $35."
Jeez.
And she's like, you know, I hope you know, you're not upset. I said, no, I don't care. But it's like, you know, out in her neck of the woods, that's going to be $3 or something or whatever at a hotel, or $5 at a hotel. Now everything's, because everything is just so crazy in New York when it comes to price. So I don't like using these one numbers, and I don't know if a better way to look at this is, you know, looking the difference between the mean and the mode. So the mode tells you where half are above and half are below, and maybe that helps get rid of some of the skew. Because if all the money is sitting there, all the spending is being done by 10% of the population, and then you run around saying, "Oh, the world's hunky dory," but in fact, you know, you've got 50%, 60% of the population really struggling. So I take all economic statistics with a grain of salt when you know, because I think about more of this as terms of investing, and what's a good company that's likely to do well in whatever environment they're in, and who's executing and things like that. I always like to go back to Peter Lynch's famous quote that if you spend 15 minutes on economics, you've probably wasted 12 minutes. You know, because he was a stock picker. He was a company picker. What companies are offering goods and services that people want? You know, what are goods and services that he sees, you know, his wife bring home for the house, and his kids, and what kind of
That's
products
what
are
I use
they
the
buying?
Holly Index for.
Yeah, that's why I use the Holly Index. Yeah, it's like, you know, that's where rubber meets the road. And so I tend to focus on individual companies way more. I only kind of think about economics as if I think something is about to seriously roll over. So like when I was at Bank of America, we had a huge, we made a big negative call on the mortgage brokers, and then that led to some other things that we did, but that's where the whole process started. It wasn't really so much as a economics call as that the mortgage market was becoming dysfunctional, and it turned out to be that it was much worse than we even imagined. Um, but we like to I like to focus on an individual industry, individual company, and uh, and make judgments. You know, there's
I rem
always that thing: don't bet against the U.S. economy. Listen, if a person can make a product and sell it at a profit, they're going to do it, and that means over time, share prices are going to go up.
you know that the work that you did when you were at Bank of America, when for those that don't know, Mark was he was the head of derivative strategy at Bank of America, and I remember some of the work that you put together at that time. That was the early days of our friendship, actually.
Yeah,
It was before you even published your first book. I think even before you wrote that first one.
yeah.
I somewhere around here I have a transcript um, of that book as well. McGraw-Hill, by the way, folks, if anybody's interested, quantitative analytics and debt valuation and management is the title, if my memory serves me correctly. Is that right?
Yeah.
You know, it's an interesting read. So before we get to some more single stock types of stuff, which I want to, I was just thinking, what would you think about selling strangles on TLT, given the fact that vol's over 15? I'm looking at, so the April 30, which is, whatever, 40 some odd days away, close to 50 days away, you could sell like an 85.96 strangle. One quick point, folks, just to think about, and that is that for any underlier that pays a dividend, so, a bond fund will pay a dividend, anything that pays a regular dividend, for any expiration that captures a dividend, you will see that the upside call is going to be lower and the downside put is going to be higher because there's not going to be an arbitrage. All else equal, you expect a security is going to decline by the amount of the dividend when it goes ex-div.
Yeah.
But I was noticing that the April 30th 85.96 strangle with TLT at about 90 is, we'll call it 62 cents. So we'll just say that that's 70 basis points over a relatively short window, right? So that's another way to potentially collect yield and not, the risk here, of course, is that you're not covered on that upside. Do you think there's much risk that Treasuries could, what would it take for Treasuries to really take off? That would be a big move for Treasuries to get through, call it 96.70, which is where that trade would lose money to the upside. That would be a 6%, 7% move to the upside.
Yeah.
In
Well, that would be a
half.
market crash scenario, an equity market crash scenario, which I don't see. I think any sell-off that we're going through right now, I see this as being a pretty well-behaved sell-off, where this is not going to be like, when I first started trading bonds, 6 months later, we had the crash of 87 and stocks fell 22% in a day. I don't anticipate anything like that. And the equity markets. In fact, when we were talking about this earlier today, I thought, well, we've gone down about 10%. We're kind of due for a 3 to 5% bounce, and then I think that'll be followed by another 10 or 15% sell-off, and that's going to be it. That's my view. I don't know, and my guess it will take a few months for that to play out. So, we'll be frustrated for a little while. And I think that the stocks that are going to be doing the bigger selling are the Mag 7s, the ones that went up the most, are the ones that are going to fall the most.
So let's take a look at, I pulled up unusual whales here. It's, we're late in the earnings season. So as we look at the earnings calendar, you're going to see that it's the board is not littered with a whole lot of names here. You can see this is a fairly sparse display.
Mm-hmm.
But there are some important names in here from my perspective. So a few of them touch on the things that we were just talking about. So Federal Express is going to be reporting next week on Thursday. I can probably try to blow this up a little bit here. Let me see if I can expand this a little bit so people can see what's happening. Federal Express has an expected move of about 7.77% by unusual whales calculation. By the way, if you're looking at the straddle is 9% that expires at the end of next week. So the calculation that they're doing is the implied move effectively for the day of, right? And if you think about the implied move for the whole week, that's going to be your straddle price, which is about $22 or about 9% of the current stock price. And I was thinking about this, and I was thinking, there's really two things that we have seen oil prices decline. Jet fuel is a cost. Fuel in general is going to be a cost for them. I don't remember what they do offhand to hedge it. But the concern, I'm assuming, is on the tariff front, because if you reduce international trade, even if you create a hiccup,
Mhm.
that's going to. So we usually think about FedEx as, white van pulls up outside, drops a box at your front door. But of course, they're flying a lot of planes back and forth
Mhm.
across oceans, and they have a lot of containers in those things, and that's a potential risk. What are your thoughts about FedEx going into the earnings print next week?
I'm okay with them. I don't know that they're going to outperform. They'll probably guide down. So my guess is
Mm.
that the stock will sell off on whatever number they put out there because of that guiding down, the uncertainty, and a little slowdown in trade. I don't expect that to last for a long time. Um, and whatever happens, as much as we don't like to see that, we haven't really been fair about um, tariffs in this country. Average tariffs are just a few percent on average of products coming into the U.S. And U.S. manufacturers face sometimes, 50%, 100%. Tariffs are so high in Japan, no U.S. car manufacturer could ever sell a car in Japan, for example. I'm just learning that a whole lot of agricultural products get hit with anything from a 50 to 250% tariff going into Canada. Um, and so this is sort of like the backstreet brawl that's going to have to go on to say, hey, what's good for the goose is good for the gander. We're happy to have low tariffs here. You got to do the same thing in kind. And these are a lot of countries that do this are also countries that are benefited by a bunch of economic aid. The I forget which Congress person said this, but and it made me scratch my head is when was the last time a country gave some money to the United States? Uh, and I don't think that's ever happened. Since World War II, we and there's reasons for it because we were doing well and others don't, and then we want to see other countries do better. But it's at some point everybody's, Western Europe is their economy is bigger than the U.S. now. Why we're subsidizing their defense, I don't know. They can take care of themselves.
Yeah, actually, it's interesting. You were asking when's the last time they sent us money, and I can say when that was and why.
Okay.
And it was the first Gulf War.
Oh, okay. Yeah, that's right.
So,
That's right. Everybody
uh,
pitch in.
yeah. Obviously, it's an important element. We've kind of let a number of countries slide on the percent of GDP that they were supposed to be allocating to defense spending within NATO. And I agree, it's a question of fairness, and they absolutely should. I was very surprised to see one line item that showed up in the U.S. AID spending, which was $3.2 million subsidy to the BBC.
Yeah, that
What?
shocked
What?
me as well.
What? Why? It's the UK is a developed nation.
Yeah.
There's little reason, and the BBC is government
Government owned.
owned and operated. So why? It's astonishing. We hear about cuts to things like National Public Radio in the United States, and if you listen to NPR as I don't as much, but it used to be my default. I would get in the car and my radio was just tuned to NPR, and I would listen to folks like Terry Gross and
All things considered. Yeah.
All Things Considered, and Car Talk was always really enjoyable. I liked a lot of the NPR programming, and I actually think that their coverage, Kai Ryssdal.
Yeah.
I don't know if you know who Kai Ryssdal is. I like listening to Kai Ryssdal.
What's their business bit?
Yep, the business bit. I don't listen to it as much because I'm more of a podcast guy now. And besides which, because I'm following the markets, it's not like I really need somebody to tell me what I've been looking at all day.
Yeah.
But,
I think that to
Um,
add to your point, most people don't realize, but UK citizens pay a tax to fund the BBC. It's not like, that you're subscribing to them on cable. It's no, if you have a TV, there's a guy rapping on your door saying, you've got to pay some money for this TV service.
so
It's
I
an aside. Go ahead.
Yeah, so I was gonna say, we Dollar General. So we were just talking about the consumer, and I'm pretty sure I don't see it here. I thought, am I missing it? I thought Five Below reports next week. Is that? Do I have that
Yeah,
right?
all the dollar names, Dollar General, Dollar Store, are suffering. Kohl's, which is sort of a middle to value-based um, department store,
Mm-hmm.
they are really suffering. Um, and maybe that's just the way people are shopping, because also places like Macy's have been suffering for a long, long time. Um,
Dollar General, yeah. So it caught a bid. They had a disappointing print this week, and Five's going to be reporting next week. Dollar General caught a bid on the after their earnings, and I wanted to point something out really quickly to folks who might be looking at this and saying, "Hey, at what point do these stocks become cheap?" And I'm going to want your opinion on this because I think this goes to valuation. So I was looking first at Dollar General, and I said, I was saying to myself, "My God, look at this thing! I mean, it's basically right about where it was 10 years ago." Right?
yeah.
So the stock's about $78. That's where it was 10 years ago. So then my next question was, well, how much has the company grown, right? So that's be kind of the next thing. You'd say, well, what was I paying for it then? What am I paying for it now? So if you go back to 2015, the company had revenues of 18.9 billion, and you fast forward to this year, so the full fiscal year, we're probably looking at about 42.2 billion.
Mhm.
So, you know, immediately I was thinking, well, wow, that's quite extraordinary. We're talking about, it's 2.2x on the revenue side, and the market capitalization is $17 billion, and isn't that cheap compared to the 20 billion that it was? But of course, you can't stop there, and so I just said, I wonder if this company's taken on much in terms of debt, and boy have they. So this thing was 2.7 had 2.7 billion dollars in long-term debt and 580 million bucks in cash 10 years ago, and it's got 16.5 billion
Yeah.
in net debt now. um you're a debt guy. At what point do you get worried? And actually, I didn't even bother to check what you were talking about. Is this considered high yield? I wonder what their credit rating is. I think that's RA 122 if I remember. Is that? No, that's not what it was. What should folks be looking at if you're concerned about a potential credit event? Because to me, you were talking about an orderly decline in equities, and I have always thought of, so you can have an orderly decline on things like valuation. Where you really start to get into trouble is when you have excess valuation, declining economic numbers, and a credit event or credit
Yeah.
events. Where do you think the potential risk on the credit side might be?
Um, that's hard to say. I don't think overall we're too over leveraged as an economy yet. Maybe the government is, but I don't think corporations are too over levered yet. There might be individual names that I'm not aware of. The reason why I think Dollar General and others have become more heavily indebted, however, is because they were essentially paid to do so. Ever since the financial crisis, great financial crisis of 2008, 9, and 10, um, the yield to maturity on corporate bonds was at or below the inflation rate. So it behooves you to go issue debt, buy back stock, and play that game. It's when that game comes to an end that there's a problem. I don't know if we're at that stage yet or not. My senses were not. But I do know there are some troubles. I've been reading articles that there's a few million people that are behind on their FHA mortgages, and
Mm,
the
yes.
government has not been foreclosing. Instead, they have been either one making people's mortgage payments for them. That's what I read. I don't know that to be the case. If they are, I'd be shocked. But instead, they're just letting them uh, go like a pay in kind bond, where they're just capitalizing the payments they're not making, and so their loan balances are going up.
This is, yeah, I mean, this is a hugely important. Um, so, yeah, I would actually, anybody who's watching this who might be interested in what it is that Mark is referring to, if you have access to the Wall Street Journal, there was an article about this exact issue earlier this week. It was like a day or two ago, right?
Yeah.
Um, and yeah, it basically what's going on is they're essentially allowing people, and it's not being charged interest, but they're able to take those unpaid amounts and roll them into the actual mortgage. So the amount of the mortgage is going up
Yeah.
in these FHAs, and the number. And again, forgive me because I'm just going completely off of memory, but I thought I saw something like 568,000 delinquent mortgages where they had basically come up with some kind of a resolution, right?
Okay.
So, and well, and what we commonly refer to this is when you restructure debt. That's what you're doing, right? So they're just basically restructuring the debt, but you're not solving the problem. Arguably, you're making it worse. Someone's going to have to pay the piper sooner or later. So try to find that. I'm going to actually try to see if I can find this article for anybody who's watching now or later. And you know what? This is what we'll do. We'll ultimately put it into the description on this video. So if we don't do it by the end of this live stream, then be sure to come back for that, because I think that's going to be really, really quite important. FinWest just said, FedEx, Mike's favorite. Yeah, this thing is the best. It's been a bane of my. There it is. Okay, so it was the government mortgage relief with is no cash cow. That's the title of it. I don't know if we can. Let me see. This was. Let me see if this is it. I'm pretty sure. Yeah, this is. When was this article? This was this was last week. It looks like. So yeah, we'll put those into the description. I think that's really important. Also coming up, I think I saw on Unusual Whales Carnival Cruise Lines, and the reason Carnival Cruise Lines. Let's see if we can see this here. If everybody can read that, that one's also expecting a move of close to 8%. Carnival Cruise Lines caught my attention because one of the things I read also was that bookings, so vacation bookings and things like that, had dropped to something like a 15-year low, and Carnival Cruise is at services the lower end traveler. I think Royal Caribbean and Norwegian are a little bit higher end. So I was wondering if you had any thoughts about that on the consumer discretionary side.
Well, I've also, and I was going to raise the issue about the airlines. The airline stocks have been hit pretty good. And I think they seem to be been hit too hard to me. What is Delta down, for example, peak to trough? 30%?
Let's take a look at Delta here. Delta's look. This is actually, it's given back all of those gains, although it was kind of a hockey stick.
Oh, okay.
Let's be honest. But yeah, we are now back to levels from. Wow, it's actually the stock's back to where it was end of year 2020.
Yeah, and it's worth noting that that chart is also including dividends. So you haven't made any money by owning the stock that entire time. And that's kind of harsh for a company that's actually making good money. Um,
Yeah, this is really an interesting case because uh, the company actually carries less. Well, it's actually not that surprising. I mean, a lot of these companies, this includes the cruise lines and includes the airlines, any business where they had massive fleets of depreciating assets that require any, capex dependent business, any, business that had a lot of maintenance expense, and then got shut down by the pandemic, they just turned into a complete disaster, in terms of their cash flows. What's interesting is that Delta, has essentially, and one thing, if you're looking at this chart, I don't know if people can see it, their net debt. So this is the important thing. You'll notice that they had about $35.5 billion worth of debt at the end of 2020. But just pay attention to the fact that a lot of these businesses either were, they were keeping a lot of cash on hand out of necessity. And so when you see that debt has fallen by $13 billion, which it has, also just pay attention that it's really the net debt that you ought to be
yep.
thinking about a little bit in terms of the enterprise value. And essentially, businesses, exactly as you would imagine, in a pandemic environment, if you were running a business, you would say, let's get as much cash in as we can possibly get. If we have to borrow, if we're going to increase our interest expense, but liquidity was really critical. And so, that was kind of important. But it is interesting to note that right now, on a $50 billion enterprise value, the full year forecast for free cash flow is about $4 billion.
Yep.
That's quite a handsome free cash flow, relative to the enterprise value. So EBIT to enterprise value is very attractive. And if you're just thinking about it in terms of free cash flow yield, on the equity value, that's 13.8%.
Yeah.
So there's a lot of bad news baked in to this cake.
Yeah. So I think that if you're going to do your homework and you want to buy some things that are off the run, not the Magnificent Seven, you can find some good things to buy.
Yeah.
And this will be the first time in a long time, because if you compare the returns on the S&P 500 market cap weight versus equal weight, the equal weight index has been underperforming forever, it seems like.
Mm-hmm.
And I think that tail might turn around. I also
It was one of my themes for this year, actually. My acronym for CNBC Rising begins with RSP, which is the equal weight ETF.
and one of
And it is outperforming so far this year.
yeah, one of the things we've talked about in my investment analysis class, is we look at different asset classes, and one of the great underperformers has been EEM, the ETF that tracks emerging market stocks. I mean,
Mm-hmm.
that has been a massive dud. And I think, and I always think in terms of cycles and mean reversion. That's probably an area that we think will outperform. And I think I've made a bullish call on that over at the Options Edge website, a couple of weeks ago, for as an area for people to look at. So
Yeah, I mean, it captures a little bit of China, which is a little bit iffy for me, but I do feel like in general, on evaluation, this was an area that was priced for growth many, many years ago, and now is priced as if is going to experience negative growth,
yeah,
which doesn't seem quite right. I wanted, actually, while we were thinking about it, I was thinking about this because this was something that my former colleague Andrew Shirley from Ivory, he was my boss actually when I was at Ivory Capital many, many years ago, something he was looking at. So for those of you who are watching who are saying, oh, how does one go about picking stocks in an environment where it seems like all stocks are going lower? And I wanted to make the following point, which is, sometimes you can do things like trade a pair or look at the relative value between two businesses. The one that he pointed out, which I thought was kind of interesting, was A&F, Abercrombie and Fitch, and he was comparing it to Nike. And his point was that, Abercrombie. So this thing is right now full year $11 a share in earnings, round numbers. I like to use round numbers. So, we're looking at 7 times full year estimated earnings.
Yeah.
Free cash flow yield of, we'll call it, is that right even? 14%? 14% free cash flow yield. And you'd say, okay, well, this is consumer discretionary. And I agree that's tough. But Nike is also a consumer discretionary. Mm-hmm. And you don't get anywhere near those kinds of numbers.
Yeah.
So Nike's forecast is that they're going to continue to see, that their year-on-year top line is going to see declines. This thing is trading 30 times estimated earnings or more.
Yeah.
So what do you think?
Maybe what I would
long
do
Abercrombie, short Nike?
Yeah, I think that works. The other thing that I would be looking at is if you use some of these screening tools, like Yahoo has one, I think CNBC has one. Look for stocks that have PEG ratios getting close to 1. Those are companies where they're kind of being left for dead. I would guess, Abercrombie is in that category. The airlines, I would guess, are getting close to that category. And use that as a way to go find some companies that are just been massively ignored by the crowd. And then do your homework and figure out what you might like. And you're
check this out. You want it?
Yeah. So you're
here's a company with a PEG ratio of 1. You ready for this?
Yeah.
NVIDIA.
Yeah, well,
it was actually below that earlier this week. The stock got down, well below where it's currently trading. And look,
well,
NVIDIA has that pigs in a python issue, right? Yeah. Which is that for those of you who don't know, the pigs in a python is it's usually used to describe demographic shifts, but in other words, you can't just simply take a growth rate and extrapolate to infinity from there. You have to assume that there's an unusual build-out going on. Nevertheless, it was very surprising to me to see this business trading at a valuation essentially that, this is what it was trading at 10 years ago also.
Yeah. So I'm not really thinking about companies growing at 60 with this PE of 60 growing at 60% a year. I was thinking more in terms of stocks.
This is trading at it's trading 26 times.
Okay, so 26 times. Okay, so I guess they're projecting out 26 times.
Yeah.
Growth rate, 26% growth rate. I'm thinking more in terms of companies with a PE of 8 to 12 with growth rates to 8 to 12.
Yeah.
Which are repeatable for a lot of years. That's what I'm thinking about.
Yeah, no, I think that makes a lot of sense. So Finwest asks, he has a question for you. Mark, what's the career path for most of your students? Financial services industry, like financial advisors, hedge fund managers, or completely different? Where are they going typically?
I have students that are kind of going across the board. We are able to place some young people into wealth management. We're getting a lot of in corporate banking. Loan origination, that kind of stuff. We do get a fair number of kids that are willing to go to middle office with the opportunity to get into front office in things like fixed income and derivatives.
I worry a little bit about the middle office positions with technology. There's a lot of disintermediation.
Yeah, absolutely. We've got an extremely strong Masters of Quantitative Finance program here, and we place a lot of people in the risk management side of things there, which are really super quantitative jobs, and that's what a lot of those people go into. We've been able to place a few of those into crypto firms, things like Galaxy, for example, which is a Canadian company with a big office in New York. They've picked up a few of our students. And I would like to get more down that route. I'm teaching a digital assets class for the first time this semester. So it's a little bit of an experiment that the of how, because I see fintech as a an engineering solution to a financial problem, and I'm not teaching engineers. I'm teaching finance people, and so I have to.
You're teaching financial engineers.
Well, not at the undergraduate level. So the graduate, yes, but not the undergraduate. It's trying to get them to just understand the product and how it fits in and how you might want to incorporate it into a portfolio and your financial plan and things like that.
So Michael Walter's asking a question here, which I think goes to, I think we've touched on it, but is probably just is worth another go round. Given the current conditions, do you think it is reasonable / possible for averages to decline another 10 to 15% and average PEs go below 20 times? And I think you actually said something like that almost to me verbatim.
Yeah.
Although not another 15%. I think you said maybe peak to trough 15%, or I
Well,
was trying to remember what you said.
basically what I was saying is we've gone down 10. I expect a bounce to 3 to 5. And from whatever that level is, we'll see another sell-off of 10, maybe 15. So grand total 15 with an outside chance of 20. Okay, I would see that happening in a world where earnings per share for the broad averages are not growing. So what did you say S&P was 27?
Yeah, I mean, I actually had NASDAQ up, but I think S&P is actually trading a little bit lower now. We're probably in like 24 or 5. I think on the estimates, although those might be, it's even lower than that. Is that possibly correct?
I would see the S&P probably getting down
21
to PE in a 22, 23. Not necessarily get
trailing, because it's actually already at 21 times forward earnings estimates.
Yeah,
it's really fallen. I have to see what accounts for that.
But remember,
So
Ed Yardeni always shows that that number comes down over time. He's got some great charts that show that at the beginning of the year, all that's exuberance, and then as the year plays out, the earnings come down and so forth. So I take the forward number with a little bit of a grain of salt. I kind of equally weight that plus the trailing, and kind of get a number that way, because there is an emotional component to forward-looking earnings because it's humans making an expectation.
Yeah, so the way I like to look at it is I like to look at longer-term growth trends. I recognize that this chart right here illustrates, this has got the pandemic in it. So, of course, earnings are going to go down. I think I've often said that, if you figure that earnings, or maybe the top line can grow, call it 4 to 6%, so a couple hundred basis points better than GDP growth. My logic being that the S&P is going to reflect the best performers in an economy. And then the earnings often, for a variety of reasons, will tend to go up a little bit faster than that, assuming that the cost of capital doesn't get completely out and, all of a sudden you have to start borrowing money at crazy numbers, then that's going to hurt it. So, but assuming that stays under control, then I would usually think of that top line growth estimate as the base case for my earnings estimate growth. So figure, 7% maybe EPS growth, and you can see that the 10-year history is right about there.
Yeah.
This number that you see on the right-hand side, that's a quarterly number. And so if you figure, okay, we're going to take that to 1.08, that's $70 for the, assuming that growth trajectory gets you to $70. So that would be an annualized EPS of about 280 at the end, but of course you're not earning that through the whole year because earnings are going to be going up a little bit. So figure 270, 275 maybe. And again, instead of going and trying to take the problem, I think this is what Yardeni was probably referring to, and I think what you're alluding to as well, which is that there's a real temptation when you look at companies, individual companies, you get very much in the weeds. I've done this myself, and you kind of you listen to the conference calls. Sometimes you get pulled up on a stock just because you're talking to the people that are involved with the business so often, and you begin to take the best periods that they've had, and then you start drawing lines out and saying, oh, well, that's just going to grow like this. And of course, there's rarely in these conversations, conversations about the kind of setbacks that businesses will often face. New competition comes in, or new innovations come in, or recessionary impacts come in. There's always something. And a lot of times those things get thrown out as unusual, right?
Yeah. Changes in consumer preference.
Right. Yeah. So nevertheless, so at 270, so 56.25, which is about where we are now, 275. Yes. I mean, we're about 21 times. So
you could get there.
The mean is 18%.
Yeah.
So that's a 10% decline from here. That is the long-term average mean for the S&P earnings for the last 35 years. So that's 10% lower than we are right now, give or take.
Yeah. Okay.
And that would get us back to the mean. And you will overshoot sometimes. In a bear market, you definitely overshoot.
Well, you have to overshoot. If the mean's going to be 18, you gotta
That's right.
You've overshot on the upside. You got to overshoot on the downside. Otherwise, the mean is not going to be there.
Right. But I think 20 times is not a bad place to be if you're long, right?
Yeah. No, if the world looks okay, and then it's probably an okay time to continue allocating. Another good time to wait is when does Warren Buffett start to unload that $280 billion that he's carrying around Omaha?
I think it's even more than that. I think it's like on the high side of 300. I think it's like 330 billion.
Yeah, so
that's a lot of cash.
That might be your signal when something gets roughed up and he's willing to start committing capital.
So there's a great Peter Lynch quote. You mentioned Peter Lynch earlier. Tucker D. Dog says, "Go for a business that any idiot can run, because sooner or later,
one will.
Any idiot probably is going to run it."
Yeah. Simple businesses.
Yeah. Well, we have chewed up an hour and 15 minutes having an enjoyable conversation as always, and I hope as everybody goes into the weekend that sometimes these can be very trade specific. I think maybe strangling up TLT, FinWest for you if you're interested. I don't understand why Abercrombie's trading so much cheaper than Nike. These are both discretionary stocks. I think discretionary can get hit because, as I pointed out, the lower-end consumer is stretched and the upper-end consumer is starting to rein it in their spending a little bit. That's not a good recipe. But if you put something like that on as a pair, maybe buy a call spread in one, sell a call spread in the other, or even sell a put spread in the one you want to be long, sell a call spread in the one you want to be short. The thinking is that we're in a slightly higher volatility environment, which makes yield collection a little bit more attractive, and some of the damage has already been done. And to your point, Mark, the sell-off's been fairly orderly.
Yeah,
right. So
the numbers are big because our index numbers are so big. So, but nothing has happened that throws fear into my heart. Now, maybe that's the problem. Maybe we need to have some of that. Little heart palpitations before we find a bottom. I don't know, but I think the world is in pretty good shape.
We could get a ceasefire.
With the caveat that government spending has to come down a lot.
Oh God,
that's going to be a drag on GDP. And I do think valuation is very bifurcated. So there are some companies that
FinWest says hit the thumbs up, subscribe, thumbs up. Hit the notification bell, tell your tell your friends and relatives. And actually, yeah, like I was saying, we could potentially get a ceasefire.
Yeah.
That's something that's being discussed. And one other thing that if anybody watching hasn't looked at this, it makes for an interesting read. Well, an interesting read if you like to look at numbers. Take a look at federal spending since the beginning of this fiscal year. So the fiscal year for the federal government runs from October 1st to September 30th. And federal spending at the tail end of last year and early this year on year, is up 13% year on year. So when everyone's panicking about these Doge cutbacks, I hate to say it, but they arguably need to cut more, and a lot of this has to do with the refi risk that you and I have previously discussed, which is that net interest expense is rising. Even forget about the sort of the primary deficit. The primary deficit being if you ignored the debt service, you just took a look at whether or not you're balancing the budget. If net interest expense keeps rising, just to remain at a current sort of level of deficit spending, we'd need to cut even more severely. And it is. So I'll ask you this one question before we go. The theory is out there, and some have probably heard this, that the Trump administration's effort with this on-again, off-again tariff and all of these things, it seems very haphazard. But a hypothesis I've seen proffered, which I kind of agree with, is that I think they are trying to get the long end of the curve down. And the way you have to do that is you actually have to bake a recession into the cake. People have to think a recession is coming, and then the long end comes down, and then you can get two things that you need: liquidity from the Fed at lower rates. Do you think there's a possibility that behind closed doors, that's what they're really saying?
They could be very well thinking about that. They've got to do something to get inflation expectation down. That's the free way to save a bunch of money. If they can convince everybody the inflation rate is going to be down to 2 or less, people will be able to be willing to buy bonds, not at 4.5, but 3.5 or 3 times $35 trillion. That's a lot of money over time, and I'm sure that there is some of that going on. They do need to do a lot more. That to me, the deficit. People look at GDP a lot, and to me, the bigger the deficit gets, to my way of thinking, the economy is getting sicker and sicker. For two reasons. One is to keep GDP up, the government's having to spend more money. And we know the government doesn't spend the money very well. Just think about if you decided to give your neighbor your paycheck and you asked him to pay your bills for you and take care of you. Do you think he'd do a decent job? Well, of course not. Well, we're just doing that at the infinite level when you turn your money over to the government and think that they're going to spend the money wisely. No, they have their agenda. They're going to spend money in ways that they fulfills their agenda and what's in their self-interest. So
that's not a great cheery note to end on, but we do have to wrap it.
But what I'm just saying is it's got to come down. The bigger the deficits are, the less.
Yeah. I think we all recognize that.
And that's what Keynesian economics tells us to do. When you're in a recession, spend more money, get us out of the recession.
Local, state, and federal spending in the United States is over $12 trillion. Is about $3.2 trillion for the principal entitlements of Medicare, Medicaid, and Social Security.
Yep.
So if you take that out of it and call it, $9 trillion. Well, $9 trillion in government spending on a population of 330 million is a lot of money, per capita. And that's something to think about. So I like to have that sort of Harper's Index way of thinking about it, the eye-opening statistics. But that's an eye-opening one because we usually talk about the federal spending and not the state and local. For you that hung around for this sort of extra few minutes for us to talk about these cheery topics, we thank you. We hope you guys have a great weekend. Mark, I hope you have a great weekend. I'm really looking forward to our conversation.
Spring break, yoo-hoo!
Oh, really?
Spring break
Oh.
has started, yeah. So we get a week off.
Oh,
I'll be
are you
working
going to
all
be joining
week,
us
but the
next
students
Friday?
get a week off, yeah.
You'll be back next Friday though?
Oh yeah,
or...
yeah. I will. I'll be doing this from
Awesome.
my home office instead of my school office.
All right. Well, I look forward to that, and thank you all very much for watching.
Okay.
We'll see you next time.
Thanks for that.